Let me start this video a little differently. Not with price, not with a chart, not with a forecast, but with a simple observation. This is the moment many silver accumulators were waiting for, without knowing exactly when it would come. Not because the whole structure was going to crumble tomorrow, but because sooner or later the math had to show up. And March 2026 is not just any month. It's a test, a quiet test. And the silver market can't keep pretending it's only paper. Stay with me until the end, because this is not about getting rich quick. It's about understanding where we are. If you're new here, welcome. My name is Ken AG. I don't sell illusions, and I don't treat silver like a trade. I look at silver as structure, system, and time. If you value this kind of analysis, subscribe to the channel, turn on notifications, and comment at the end with what you think comes next. That helps this channel stay independent. Quick disclaimer, this content is educational. It is not a buy or sell recommendation. Always do your own research. Now let's get to the facts. February 2026 made one thing very clear. When delivery time comes, behavior changes. In the first days of the month, nearly 19 million ounces were taken for physical delivery in less than 1 week, practically the entire volume of last February. And the most revealing data point wasn't the volume. It was this. Almost all open interest was considered for delivery. Not rollover, not arbitrage, delivery. That tells us one simple thing. Buyers do not want paper. Now comes March. No noise, no shouting. The numbers are public. Approximately 80,500 open contracts, more than 400 million ounces promised. COMEX registered silver, approximately 103 million ounces. I'm not saying 100% turns into delivery. It never does. But here's the key point. If just 25% do what February did, the math doesn't work, and the market knows it. This isn't an isolated COMEX event. Look at the rest of the world. China, SHFE plus SGE with less than 30 million visible ounces. Ongoing absorption, zero signs of backing off. LBMA, estimates suggest approximately 150 million ounces of global free float. That's not excess. That's structural tightness. Now let's get to the signal almost no retail investor understands. Lease rates above 6%. That is not normal. When leasing rises like this, it means difficulty finding metal. Banks paying up to cover positions. Invisible but real stress. That is the canary in the coal mine. The market doesn't scream. It whispers first. I want to be very clear here. This does not guarantee a default tomorrow, an immediate collapse, an automatic price explosion. The system will always try to push, roll, negotiate, cash settle. But every cycle like this costs more credibility. And March is one of those moments when paper is forced to talk to physical. And that conversation is not always comfortable. If you've accumulated silver over the years, you've heard that it was crazy, that it was a pet rock, that it yielded nothing. And still, you accumulated not because of hype, but because of conviction, not to sell fast, but to move through cycles. This moment is not about euphoria. It's about validating why you accumulated in the first place. The next few weeks matter, not because everything is ending, but because the system is being openly tested. Now I want to hear from you. Do you think March passes like just another expiry, or do you think it leaves marks on the market? Leave your comment. I read them all. If this video helped you see what's behind the noise, subscribe to the channel, share this with someone who still thinks silver is just paper. The screen price is temporary. Physical always forces the truth. Let me show you exactly why March is different from previous delivery months and why the numbers we're seeing now represent a structural shift, not just a temporary squeeze. First, let's talk about what delivery behavior actually means. When a futures contract approaches expiry, traders typically have 3 options: close the position and take profit or loss, roll the contract forward to a later month, or stand for delivery and take physical metal. Historically, 95% or more of contracts get closed or rolled. Futures markets exist for price discovery and hedging, not physical delivery. That's normal. That's how the system was designed to work. But when delivery intentions spike above historical norms, when you see 70%, 80%, 90% of open interest moving toward physical settlement, that's not normal market behavior. That's a statement. And February's behavior was exactly that, a statement. Now, why does this matter for March specifically? Because March is traditionally one of the heaviest delivery months in the silver futures calendar. December, March, May, July, and September are the active months. March historically sees significant commercial hedging activity, industrial buyers locking in supply, and investment demand from those who understand the delivery mechanism. But this March is entering with a setup we haven't seen in years. You have February's delivery demand still being processed. You have registered inventory that hasn't rebuilt meaningfully. You have lease rates that haven't normalized. And you have global inventory across all major exchanges sitting at multi-year lows relative to open interest. That's not one red flag. That's a pattern. Let me break down the registered inventory situation more clearly, because this is where most people get confused. COMEX has two categories of silver, eligible and registered. Eligible means the metal meets exchange standards and sits in approved vaults, but the owner hasn't made it available for delivery. Registered means it's available right now to satisfy delivery obligations. As of late February, COMEX registered sits around 103 million ounces. That sounds like a lot, but context matters. In 2020, registered inventory was over 150 million ounces. In 2015, it was over 180 million ounces. We're sitting near the lowest levels in a decade, while delivery demand is near the highest levels in a decade. And here's the critical point. Registered inventory can be withdrawn at any time. If a large holder decides to convert their metal from registered to eligible, or remove it from the exchange entirely, that available pool shrinks instantly. During the first week of March, if we see delivery intentions matching February's pace, you're looking at potential demand for 15 to 20 million ounces. That's 15% to 20% of total registered inventory in 1 week. Now the system has mechanisms to handle this. Vaults can shuffle metal. Eligible can be converted to registered. Emergency liquidity can be arranged. The exchange can change settlement terms if necessary. But every time the system has to bend, every time it has to improvise, every time it has to rely on emergency measures, confidence erodes. And confidence is the only thing holding paper markets together. That's why March matters. Not because it's guaranteed to break something, but because it's revealing how thin the margin of safety has become. Now let's talk about China, because this is the other half of the equation that most Western analysts completely miss. China's physical silver market operates on a different set of rules. The Shanghai Gold Exchange and the Shanghai Futures Exchange are the two main venues. And what we're seeing there is absorption without hesitation. Chinese buyers have been paying consistent premiums over COMEX prices for months. Not occasionally, consistently. Premiums ranging from 5 to 12 per ounce, depending on the week and the specific product. Why would Chinese buyers pay 12 more per ounce than the COMEX screen price? Because they can't get the metal at the COMEX price. The arbitrage that's supposed to close that gap, the mechanism that's supposed to keep global prices aligned, isn't working efficiently anymore. That tells you two things. One, physical metal is not moving freely across borders the way it used to. Two, Chinese demand is structural, not speculative. They're not trying to flip silver for a quick profit. They're accumulating for industrial use, for strategic reserves, for long-term portfolio allocation. And here's the part that should concern anyone still holding paper silver products. China doesn't care about your ETF. They don't care about your futures contract. They want tonnage, physical, delivered, in vault. When you combine Chinese demand with Indian demand, which also remains elevated despite price increases, you're looking at the two largest physical markets in the world, both pulling metal consistently. That leaves less available for Western markets. That leaves less available for COMEX delivery. That leaves less buffer when delivery months like March come around. Now the lease rate signal. This is technical, but it matters. Silver lease rates represent the cost to borrow physical metal. Banks, bullion dealers, and large institutions lend silver to short sellers, to manufacturers, to anyone who needs temporary access to physical metal without buying it outright. Under normal conditions, lease rates sit between 0.5% and 1.5% annually. That's the cost of borrowing. Low, stable, predictable. But when lease rates spike above 4%, 5%, 6%, that's a stress signal. It means lenders are worried about getting their metal back. It means demand to borrow is overwhelming available supply. It means the entities that normally provide liquidity are pulling back, and we're seeing lease rates consistently above 6% in recent weeks. That's not a one-day anomaly. That's sustained tightness. High lease rates often precede price volatility, Because when borrowing gets expensive, short sellers get squeezed. When short sellers get squeezed, they have to cover. When they cover, they have to buy. When they buy, price moves. So lease rates are your early warning system. They tell you stress is building before it shows up in price. They tell you the physical market is tighter than the paper price suggests. And right now, lease rates are screaming. Let me address the question I know some of you are thinking. If everything is so tight, why isn't silver at $50? Why isn't it at $100? Because price discovery in silver is still dominated by paper markets. The vast majority of silver that trades every day is not physical metal changing hands. It's contracts, derivatives, promises, and paper can be created infinitely. You can't create physical silver infinitely, but you can create paper silver infinitely. As long as the system maintains confidence, as long as most participants are willing to settle in cash rather than demand delivery, the paper price can stay disconnected from physical reality. But that confidence is not guaranteed, and every delivery month that stresses the system, every lease rate spike that forces emergency measures, every inventory drawdown that isn't quickly rebuilt, that confidence gets tested. March is one of those tests. Now, what are the possible outcomes? Scenario 1. March delivery demand moderates. Maybe 40% to 50% of open interest stands for delivery instead of 90%. The system handles it. Inventory drops but doesn't collapse. Lease rates stay elevated but don't spike higher. Price consolidates. The march toward physical tightness continues, but gradually. This is the most likely scenario. Systems don't break overnight. They bend, they adapt, they find ways to survive. Scenario 2. March delivery demand matches or exceeds February. We see 20 million plus ounces demanded in the first week. Registered inventory falls below 80 million ounces. Lease rates spike above 10%. The exchange implements emergency measures. Maybe they raise margins, maybe they change settlement terms, maybe they encourage cash settlement. Price volatility increases dramatically. We see gaps both up and down as the paper market struggles to reflect physical reality. This is possible. Less likely than scenario 1, but possible. Scenario 3. Something breaks. A major bullion bank can't source metal. A large industrial buyer goes public with delivery failure. The exchange suspends trading temporarily. This would be a systemic event, not just a market event. This is the lowest probability scenario, but it's not zero probability. And that's new. 5 years ago, I would have said scenario 3 was functionally impossible. Today, I can't say that with certainty. That's how much the structure has changed. So what does this mean for you as someone who holds physical silver? It means you're holding the right asset. It means your decision to accumulate physical, to take delivery, to store outside the system, that decision is being validated in real time. It doesn't mean you're going to wake up tomorrow and see silver at $200. It doesn't mean the system collapses next week. It doesn't mean you should sell everything else and go all in on silver. It means the thesis you believed in when you started accumulating is playing out, slowly, structurally, inevitably. Physical always wins eventually, not because of conspiracy, not because of manipulation ending, but because of math. You can't deliver what doesn't exist. You can't settle in physical when inventory isn't available. You can't maintain confidence indefinitely when the gap between paper promises and physical reality keeps widening. And March is another data point in that widening gap. Here's my advice, and this is not financial advice. This is perspective from someone who's watched this market for over a decade. Stay calm. Stay informed. Don't react to headlines. Don't react to one day's price action. Don't react to Twitter hype. Watch the data. Watch delivery behavior. Watch inventory levels. Watch lease rates. Watch regional premiums. Let the structure tell you what's happening. If March passes without major incident, if the system bends but doesn't break, that doesn't invalidate the thesis. It just means the process takes longer. Physical accumulation was never about 1 month. It was never about 1 year. It was about moving through cycles with a clear understanding of where value ultimately resides. And value resides in what's scarce, in what's real, in what can't be printed or promised or papered over. Silver is all three. One more point before we close. I want to address the psychology of this moment, because I know some of you have been accumulating for years. You've watched prices go up and down. You've heard the mockery. You've questioned your own conviction at times, and now we're entering a phase where the evidence is starting to support what you believed all along. That can create its own kind of stress, the stress of vindication, the stress of wondering if you should have bought more, the stress of watching and waiting for the moment to act. My suggestion, let go of that stress. You made your decisions with the information you had. You positioned yourself according to your conviction. You took action when others sat idle. That's enough. You don't need to be perfect. You don't need to time everything exactly. You just need to be positioned when structure matters more than speculation. And we're entering that phase now. March will show us whether delivery demand was a February anomaly or a structural shift. The data over the next 3 weeks will matter more than the data over the past 3 months, so watch closely. But don't obsess, stay informed, but don't let it consume you. Understand the mechanism. But don't confuse understanding with prediction. The silver market is changing, not because of hype, not because of hope, but because of math that can't be ignored forever. Now I want to hear from you. Do you think March passes like just another expiry, or do you think it leaves marks on the market? Do you think we're watching a slow motion shift, or do you think something more abrupt is coming? Leave your comment below. I read them all, and I'll respond when I can. If this video helped you understand what's really happening beneath the surface, subscribe to the channel, turn on notifications, and share this with someone who still thinks silver is just paper. Because the screen price is temporary. Physical always forces the truth. Thanks for watching all the way through. See you in the next video.